Welcome back to the channel, everybody. I want to talk today about the fundamental question of investing in 2022. And the fundamental question that's on everybody's mind is inflation, the Federal Reserve, our interest rates going up. And I want to explain a little bit about why that matters. Okay, so I talk a lot about my valuations for stocks and what I think stocks are going to do, and is the price going to go up? Is the price going to go down? Here's the fundamental question in the market. Has the market sufficiently priced in interest rate increases? Have they overshot? Have they, is the market where it's supposed to be? Do we need to go lower, right? And so I want to give my thoughts on that, right? So the fundamental question is, with inflation rising, do we want to increase interest rates? And I think that the answer here is yes. We want to slow down inflation. We want to keep putting pressure. Again, I've said that for the next 12 months or so, we're going to continue putting pressure on core inflation numbers, and that's going to bring down the overall headline inflation numbers. That's where we're going. Over the next 12 months, you're going to see the inflation numbers start to tick down, which will give everybody a huge sigh of relief as that happens, right? And I think that as that happens, you're going to see a pretty decent pop in stock prices because we've been so bearish, right? And I think that what we've seen the last week was there's a little bit of capitulation in terms of there just aren't any sellers out there anymore, right? Everybody who has wanted to sell has sold. And then you've got people who are just holding on, which is fine, right? That's a totally fine strategy. And I think that as you listen to people, analysts and things like that talk about things, you hear about the retail traders or the retail investors and how they're buying the dips and they're staying invested, and the institutional investors are the ones sending the stocks down, which probably is true. But I think that there's and that's causing a lot of fear and a lot of anxiety, right? Stocks going down. I'm fairly neutral on the stock market right now. And I think that I'm fairly neutral most of the time. Where I sort of sit at the moment is that I think the Fed is going to increase rates, and that's going to affect valuations across the board. And we're going to continue seeing rate increases until we're down to 2%, because for a long time, the Fed hasn't had any ammunition whatsoever. And this is a good opportunity to get that federal funds rate up so that if there is another recession that's pretty bad, we have somewhere to go. We can go back down, right? That was a lot of the fears in 2018, early 2018 or so, was that if we were to enter into a recession, the Fed wouldn't have any more ammunition. And so they started raising, and you had some tantruming going on in the market about the Fed pulling back easy money and all of that sort of stuff. And we got it up a little bit just in time for COVID to happen, and we brought it straight back to zero, right? I think that the Fed is going to continue raising interest rates for the time being, because they don't want to be backed into a corner like they were. There wasn't a lot that they could do in order to support the economy as a whole, right? We've had very loose credit for the better part of a decade, and that's fueled really, really low asset return needs, right? Required returns have dropped dramatically. And that's sort of where I sit, right? If you sort of think the stock market has generally done about 4% more than the 10-year Treasury, right? And because they've done about 4% more than Treasuries over long periods of time. As the Treasury rate has fallen, right, the risk-free rate, you got that 4% premium, and that's become a larger and larger percentage of the returns on stocks. And here's the thing, we're getting into this situation where asset valuations have been incredibly extended over a very long period of time because we've basically said, yeah, we're good with a 4% rate of return based off of our discounted cash flow models, blah, 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 right? And that's pushed stock prices up and up and up and up and up, right? And my thoughts are we need to return to normalcy a little bit here. We need to get back down to we need to get prices back down so that we're talking about 10% rates of return, which is why I think we're going to see negative rates of return in the stock market over the next couple of years, not just this year, but I think we're going to see a couple of years of negative real returns, right? Let me specify that, negative real returns, because you are going to see with the inflation that we've had, companies are going to become more, quote, valuable during this period of time because the dollar isn't worth as much, right? Which means that you need to pay more for the same value. That includes, just as much as that includes food and energy and T-shirts and everything else out there in the economy. It also applies to stocks. So what we're going to see is we're actually going to see asset valuations go on a tear. We're just going to see prices go up and up and up. But in real terms, it's going to be probably your best performing stocks are probably in real terms going to be at about 0%, and and that's going to be your best performing stocks. Because think about this for a second. We have 9% inflation right now. 9% per year inflation right now. If you get a 10% return, in real terms, you got a 1% return on your stocks, right? So I think that we're going to see, in real terms, negative returns on stocks over the next couple of years. And that's going to last for a couple of years. In nominal terms, I think you're going to see prices going up, right? But in real terms, you're going to have prices that are not, that aren't the stock market's just not going to keep up. You're going to have those negative real returns, which sucks, but it's better to have, minus 1%, minus 2% after inflation compared to the guaranteed minus 9% that you've got right now. My thoughts here are that, as that risk-free rate increases, you need to be increasing your required rate of return. Now, my required rate of return, I set at 15%. Don't think I'm going to get there this year, guys. But what I can tell you is that we probably have a situation where, in real terms, I'm going to be very negative this year. I think I'm going to be positive next year, and the reason why is because I'm buying cheap, right? I'm requiring 15% over a 10-year period. That's sort of my thing. That gives me a lot of wiggle room as the risk-free interest rate starts to tick up. So those are just my thoughts around the stock market. I don't think there's a lot to go over here other than be careful. Inflation is high. I think you're going to see negative real returns in the stock market on like an S&P 500 index fund for a couple of years. So do really solid valuation work, and that will carry the day. I guarantee it. All right. That's all that I've got for today. I will see you tomorrow, and until then, stay rational.